Hi, everyone. My name is George Lee. I'm a twice exited founder and now an angel investor in Boston. And so this is a really great panel. We're really excited and hopefully gain a lot of really great insights out of this. Love to pass it to the panel to introduce themselves.
I can start. Ari Glantz. I'm the executive director of the New England Venture Capital Association, as well as an angel investor with TBD Angels. So I'm hopeful that the former will give me at least a little insight on some of the VC questions and the latter on some of the angel questions.
I'll go next. I'm Rudina Cesari, founder and managing partner of Glasswing Ventures. We're an early stage focused firm investing in AI companies for the enterprise and security markets. Good morning.
Good morning, everybody. I'm Payal Divakaran. I'm a partner at 406 Ventures. We're a Boston-based firm. It's been around about 17 years, always focused on Series A. So we'll lead or co-lead Series A rounds. And we have three verticals. I co-lead our digital health practice. And then we also do cybersecurity and data and cloud.
All right, awesome. Thank you so much for your introductions there. Let's start in reverse order and kind of go around the horn. I'd love to hear from Payal. What's the investment thesis at your firm?
Sure, thanks, George. So I'll do it sort of at a firm level and then at a segment strategy level. So at a firm level, we, as I alluded to, we're focused on by stage at Series A. So 80% of our investments are Series A, where we're leading or co-leading those rounds, usually a $4 to $8 million check initially, and then reserving capital for follow-on. I think an important part of the strategy relates to the fund sizes and the portfolio construction. So our fund sizes have always been around 300 million, and we'll do about 20 to 24 investments per fund. And so that's actually not a ton for a Series A. It's a pretty concentrated, disciplined strategy. And then what it forces us to do, therefore, is be really thematic and thesis driven. And that gets to the segments. That's where we think there's a lot of benefits in being segment focused. And so on the healthcare side, which is 50% of our investment activity at this point, the remainder is in the cyber and data and cloud. Our thesis and our strategy around portfolio construction is only investing in companies that are doing enterprise healthcare. So these are companies that are improving the delivery of care for patients. They are improving outcomes, but they're doing it by knowing how to get to those patients by monetizing payers or hospital systems. And that's the world that we live in. And that's the world where we believe we can really change healthcare. And so I think there's sort of a fund level strategy around building the winning portfolio. And then each segment has its strategy. And on the healthcare side, it's really knowing what we're good at and where we can be ahead of the puck. Because at the Series A, I'm sure others will mention at the early stage, you just have to be able to get the real strong pipeline, but also be what we call ahead of the puck before it's sort of obvious to everybody else. And we do that by just staying in a really disciplined lane.
All right, awesome. And to continue with the boilerplate question here, Rudina, what is the investment thesis at your fund?
So at Glasswing Ventures, we are typically the first investor in. We predominantly invest in seed stage companies. Our average check is about $2 million initial check, but then we maintain very, very healthy reserves, which is an important point to highlight, i.e. we don't just write the first check and then our companies are on their own. We support them throughout the follow-on stages. Equally importantly, we also have a pre-seed program, which is smaller checks, but an opportunity for founders to get early access to the Glasswing platform and the support that we provide. Not too different from how we approach investing from 406 in that we are also thesis driven. And the way that we approach our investment strategy, to start with that, is that fundamentally we are looking for companies that are leveraging AI and frontier technologies to drive disruption and transformation in their respective markets. So we look for AI or some degree of frontier tech in every single company as a key criteria. In our view, that is not sufficient. So what we then do is we have particular thesis around markets. So as an overarching statement, I said we do enterprise and security with an AI disruption. But within enterprise, which represents about 2/3 of our portfolio, construction and therefore companies, we have specific themes and sub-themes that we pursue. And these are live, themes. So there are certain moments and times when, depending on where we are in a certain, curve and cycle, certain theses will retire, other theses emerge. So this is ongoing. But currently we have one thesis that's what we call the intelligent data infrastructure. So, and by infrastructure here, fundamental tech, not hardware. We only do software. But is how do you drive the adoption of data as an asset, management of cost, management of complexity, to fundamentally, as a core technology, to fundamentally make better use of data, and for our thesis, further adoption and penetration of AI and performance. Another thesis is productivity, and more specifically put, human augmentation and automation for productivity. This typically lends itself more naturally to functional areas. How do you drive marketing efficiency? How do you drive developer productivity? How do you automate demos or another sales capabilities? So it's really, again, sort of focused on productivity. And you look at it from an AI lens, productivity, especially if it's a human in the loop or an augmentation play, oftentimes involves repetitive tasks that you can automate. That's code for oftentimes the data underneath it, these tasks is typically semi-structured or structured, which nicely lends itself for AI and ML applications. The third bucket for us is intelligent verticals. So I'm sure many of you have heard this term around vertical SaaS. So how do you sort of go from pen and paper or Excel or some legacy software to SaaSifying and to the cloud for vertical specific solutions and platforms? At Glasswing, we take that a level higher to focus on how do you actually drive optimization of efficiency, and AI plays a role in that. So that's about 2/3 of the portfolio. 1/3 is around security that covers cyber and physical security for us, because at this point in where we are in that market, it's a continuum. And we look at things like data privacy and compliance, response management, etc. But that gives you a flavor for the buckets that we invest in. Finally, portfolio construction. We also, at least with our latest fund that we announced at 158 million, we plan to do about 20 to 25, which again for seed is pretty concentrated. But keep in mind that once we're leading and co-leading, which we do all the time, our rounds, we're taking board seats, and we are with our founders for the long term. I'll pause at that.
Thank you, Rudina. I really appreciate that. Ari, I'd love to get your kind of thoughts on VC investment theses. I know that, you're the angel representative on the panel, but love to see if you have any thoughts about VC investment theses, and then we can pivot to talking about your personal angel investment theses.
Sure. Well, I think a couple of notes for me. So one is on the NEVCA side, I've been with the organization for about 8 years. And on the angel side, just under 2 years. So the perspectives are different, but certainly one is at a 50,000 foot level, and then one is as in the weeds as you can get. For me on the NEVCA side, the way I describe what I do is I invest in people like Pyle and Rudina. We invest in firms, we invest in the ecosystem. So we invest in all of the things that go into making a VC's job easier, that the VCs themselves aren't going to have time to pay attention to, given that they've got 3 full-time jobs themselves. In my job, it's extremely exciting because I get to see theses that are as diverse as the 2 that you heard here, as well as on the life sciences side, and everything in between. I think just an observation, what I heard from both Pyle and Rudina is this sort of mixture of thesis and strategy. And the key to success in basically every venture capitalist that I see is understanding where to blur the line and how to find a way to stay true to the overall thesis of the firm, but also be able to be nimble and find the companies that don't fit neatly into any one of those buckets, but are going to represent the opportunity that these funds need to, as Pyle said, stay ahead of the puck. And then on the angel side, it's a completely different ballgame. So, like I said, I've been investing for just under 2 years, and candidly, my first thesis as an angel investor was find the smartest 5 people in the angel group to which I belong, and don't do anything unless all 5 of them are on board. And candidly, again, I think that will probably be the bedrock of my investment thesis for, I would say, at least the next 9 years. I'm going to give myself a full 10 before I start really breaking out on my own. That is, I would say, there's probably parallels to that in venture as well. You don't see a ton of solo-led deals. As competitive as venture is, everybody is also competing for the same deals and paying very close attention to what their friends are doing. So you got a lot of party rounds going on, especially in Boston. On the angel side, again, I'd say the other piece of my I really I'm hesitant to call it a thesis. I think angel investing is so much about learning and kind of taking the opportunity to find out about things you don't know about. And to that end, what I've been trying to do in this second year is start a sort of a semi-thesis a year. And so what I did in year 2 was take one of the foundational experiences that I had early on in my role at the NEVCA and use it to catalyze a focus in my first full year of angel investing. And with that, I'll tell a really quick story, and then I'll give up the mic. So one of the events that I have been putting together for 10 years at the NEVCA is called Unpitch. Both Pyle and Rudina have participated. It's an opportunity for early stage founders to meet with seasoned venture capitalists for kind of feedback and relationship building, as opposed to asking for money. In my role, I get to take a first look at all the companies that come through. And about 6 or 7 years ago, one of the companies that came through the Unpitch application pool was called PMS Bytes. And it was a little consumer healthcare product that was a nutritional supplement in gummy form for menstrual cramps, and seeking to combat all the associated symptoms. In my all my wisdom at late 20s, I said, this seems ridiculous. I have no idea what this is. And I triaged the application immediately. And then about 4 months later, that company wound up on Shark Tank and wound up raising, I think, a little over $1 million. And that experience overall has helped me for a long time be conscious of my own biases at the beginning of any process, whether it's investment or not. And then in this second year of angel investing, I've made it a point to go and try and find femtech and kind of women marketplace focused companies, because it's a place that I candidly don't know all that much about, and it's an opportunity to learn at every pitch with every founder conversation. And that's how I think about angel investing overall, and where I can bring value. That remains to be seen, and it's a subjective conversation for each.
Awesome. I love it. Thank you, Ari. Rudina, I'd love to go to you with a question. Since you were a founder at Glasswing, I'd love to hear about the insights that you had when you were thinking about your portfolio construction and the first few investments you made. Kyle, I'd love to come, with you. You kind of had a portfolio in place. So when you're making investment decisions based off of additions to that portfolio, love to get that. But first to Radina, looking at those first few investments made by a venture fund, what kind of goes into that when you're thinking about, that strategic planning, all of the potential portfolio companies that you can potentially invest in, right? Which ones do you kind of execute right off the bat?
Yeah, I mean, honestly, the starting part, especially when you have dry powder, it's the easier one. So I think Pyle got the short end of the stick on the question. But fundamentally, when you start with a clean slate, you want to make sure is that from the get-go, you remain disciplined. It's easy to say, my target is $2 million, but this company needs a little bit more. Can we deviate? It's okay. So the discipline is really, really important. And it has been key for us. So, and when you're at the beginning, like I shared with you, 2/3, B2B, 1/3, security, you can start security, you can start B2B, you can have 2 security companies and still be okay. So the beginning pieces are not as challenging as one might perceive them to be, as long as you are following your strategy, are disciplined around check size, stage, founders you're backing, remaining on thesis, and then growing it from there. If anything, and forgive me if I deviate from your question for a second, what's more important, I think, in the beginning, as you're making these first few investments, is asking your question, what is the maturity of these companies? Because they are like a maturity curve. And, what is the growth perspective of these companies? Do they have something that they can grow a lot faster than, otherwise? And how can you add value? Because as you think about Fund 2 and Fund 3, performance matters at the risk of stating the obvious. And you want those first few companies to mature and to actually show the performance, whether it's through follow-on rounds or ideally exits at some point in a not too distant future. But we do take a long-term horizon. So I think that's a key point. And then for us at Glasswing, I didn't share this in the beginning, but we take product market fit risk. So we are right there with the founders trying to figure out the first, design partners or early customers. What is, just because the platform can do 10 things really well, what are the low-hanging fruit? Which use cases will you pursue? So we are right there at the ground level with the founders. So one key facet, again, to portfolio manifests itself in portfolio construction, but is how can we add value to shorten that cycle to crossing the chasm to product market fit. And from that perspective, the way that we have constructed Glasswing, so it's about 15 team members at Glasswing Ventures. We have the core investment team at 8, and then we have a former CTO, Vlad Shenoha, the CTO of Nuance, a former CMO, 3-time CMO, Carol Myers, Unica and Rapid7 and LogMeIn, Joe Caprio, former CRO, Chorus AI, Insight Squared, etc. Ted Julian, former CPO. So when we go in, you typically have 2 or 3 founders, some developers, and they're starting to figure it out. So if anything, when we're thinking about the portfolio construction, we're thinking about, okay, Rodina is leading, and I don't know, Ali or Kyle is the junior sort of person on the investment team. But then who do we bring from our venture partners and operating partners to help these guys get quickly to the next stage? How does it shape up? So it's as much about how we can add value as it is about the stage and the type of company that we're investing. But in the early days, you don't have to make the tough calls. Pyle will tell you about the tough calls.
Yeah, I think that's well said, Radina. I joined 406 over 7.5 years ago. I joined for the last investment in Fund 2, and we've just completed our construction of Fund 4. So I did have to go through a bit of some of the more growing pains or just growing evolution of a firm on portfolio construction, to your question, George. And we learned a lot from Funds 1 and 2, namely, Fund 1, because that's the one that was fully constructed, that was in its sort of growth stage. And when you're raising Fund 3, to Radina's point, people are saying, what was the performance of Fund 1 and where is Fund 2? You can hide behind that a little bit certainly when you're raising fund one, it's all about the founders and terrific, founders like Radina. And then fund two, it's a little bit of, okay, it's too early to tell. Fund three, you don't raise fund three unless you have good performance. So what we learned about portfolio construction was fourfold. One, don't stray away from the discipline. There was some detours in fund one around things like green tech, things that we won't ever talk about again. And we said, you know what, there was a lot of discipline in staying to what we know really well. We had 3 founders, and the 3 founders led to 3 pillars: healthcare, cybersecurity, and data and cloud infrastructure. So stick to those and don't do anything different. Stay disciplined on stage as well. And so we really learned the benefit of discipline. The second thing we learned was the discipline of the consensus. We used to have in the early funds the ability for one partner to really just silver bullet, you can get something through. And we realized that those were actually our worst outcomes, or they were trending to be our worst outcomes. When we had the full consensus and you had the input from the healthcare team on something cyber and from the cyber team on something healthcare, we got to the right answer. And so there is value in the consensus and there's value in the investment committee. And so we improved that process. The third thing we learned was be more disciplined about cutting your losses. And so we improved a investment threshold horizon where we said, at the point where you get to $5 million in or above, you have to come back to the committee. Because what we were seeing was there was a lot of, especially in the early days and early funds, there's a lot of partners holding on to their investments and saying, I don't want this one to fail. I don't want this one, right? Because there's a lot of individual association and ego with your investments until you get to where we are, which is fund 5. And it's okay. I have 15 companies. It's going to be okay. Right. So we created more process that helped around dollars into companies. And what we found is that improved our ability to put dollars towards the companies that were going to go to the distance. And then the last thing is similar to what Radina said was we further found value in just the apprenticeship model of our firm and helping people grow with us so that you do get smarter and get the muscle around portfolio construction and strategy and making good decisions. We've never had anyone leave the firm besides a founder who retired, an associate who went to business school, and an associate who went to a portfolio company. So all of the partnership, besides the founders, has sort of grown up through the ranks. And so investing, for the audience who you may be involved with VC firms, or you may just be thinking about personal investing and personal portfolio, it's a muscle. And it's a muscle that you can only get better by exercising, right? Like all things in life. And so the longer that you can apprentice with it and you can practice with it, and you can have failures that don't sink the tank or sink the boat, the better you're going to get at it. And so there's something to Ari's point. If you can keep angel investing for over 10 years, you're going to get better. You're going to get smarter at it. And so we've taken that philosophy as it relates to our team and said we need to keep people, we need to do good selection up front, but we need to help apprentice and retain them. And that's going to be a winning strategy. And so last thing, we're almost done raising fund 5. And so that's where we are today. We're sort of managing $1.4 billion of capital across 4 core funds and 2 opportunity funds. And now it's entirely evaluation on performance and track record. You can't hide behind anything. And so those learnings from fund 1 and 2 are just so, so important.
All right. Thank you, Payal. In the interest of time, we're just going to be moving forward a little bit. So in the past, recent memory, we've been through multiple cyclical downturns and obviously, some great times in the public and private markets. And, given that we've kind of had this boomer bust cycle, 2000 COVID, 2021 bull run, and now into kind of this current bear market, I think it's given us a lot of clean data in terms of, up and down markets. Right now, since we're in a down market, let's stick to that. How do you as investors handle bridge and down rounds? Maybe I'll start with Ari on this one.
As an angel investor, I don't really handle bridge and down rounds. Get to that point, it's not where you want to be as an angel, which I think comes back to what I was gonna answer about the previous question. As an angel, you have to have a really strong sense of self, of who you are as an investor and what kinds of deals and companies you are and aren't going to get involved with. So I will kick the the management of bridge and down rounds to the institutional folks.
All right, great. Payal, do you want to take that?
Oh my gosh, what a fun one. And I look forward to collaborating with Radina on this one, because we have the benefit of working together as firms on some of these topics. I think a few observations or just general thoughts before getting into the nitty and gritty. So market cycles happen. And for folks like who have been doing venture capital long enough, you've seen these cycles. And so the number one thing is that seeing many cycles and being experienced is very helpful in these situations. Because one observation about the current times is that you do have a number of investors and venture capitalists who have come into the industry more recently. And so it's all really new and it's all really scary. And it's all really, that muscle has not been exercised. And so what you're seeing broadly in the marketplace is a number of companies that are struggling to raise follow-on financings, but you've got investors, board members, or syndicates that don't have the experience with how you deal with these situations. And it's going to create a bifurcation here over the next 6 to 12 months of companies that kind of hit a wall and struggle because you can't raise those rounds and you can't get it's an appropriate tool to get bridged or to have a down round in certain scenarios in certain markets. And you'll find companies that won't be able to do that. We're going to see what I'd call a wreckage a bit. Now, thankfully, I think our firms fall into the camp of, we know how to deal with this. So I think that's very helpful for founders and management teams. And so I think I'd characterize bridge rounds and down rounds as a very healthy tool in a market to help companies to extend runway and get to the next set of milestones to raise their next rounds of financing. And when used appropriately, it actually leads to great outcomes. If you look back in funds 1 and 2 for us, many of our best outcomes, there were moments in time where we bridged them, where they had down rounds and we had great exits. But I'm going to pass it to Radina to take the heavier, tactic or other thoughts on it.
Yeah, so building on Payal's point of view, you have to bifurcate. On the one hand, even speaking for my own investments, you're so intertwined with every investment. And I often joke, but not, that a lot of these relationships with the founders, especially when you've been there from the very beginning, last longer than a marriage. So from that perspective, it is really hard to separate at the individual level and at the firm level. But fundamentally, as Payal noted, some hard decisions have to be made. So I've gone through the 2001 correction, the 2008 correction, and here we are. At the 30,000 foot level, this correction feels different. It has a lot of delayed motions in it, in large part because when we see corrections in the public market, it trickles backwards. And what I mean by that is public markets, then on the private side, the growth funds and their portfolios see it, and then sort of, the later stages, until it makes its way to the earliest stage. We have just started to see that correction in the early stage. I would say it started like this fall. I mean, very, very recently. Until June, July, even August, perhaps, founders were not realizing whether there was, especially from founders that were raising their first round of capital, were not realizing valuations had changed. We were in a new paradigm, and sort of that always happens. So it's not anything new. The reason why I say it's a little bit muddier, this correction, is because unlike prior ones, we have a lot of funds that have been raised and sitting on the sidelines. I saw a statistic that there is $24 billion in raised capital from VCs all the way to private equity that is sitting on the sidelines waiting for the market to figure out what's happening. So that has been an interesting phenomenon. So the capital is available. It's not like in prior corrections where the funds couldn't raise, There was no capital. So we will see, what that means is we will see transactions, but I think we will see them at a different valuation. And then making it home sort of from our portfolio management, I think what we did in 2021 in particular and early 22 is we got most of our companies funded. So we're very, very, very fortunate that sort of it was hitting. So we really encouraged our founders to raise, and where the opportunity was to raise a little bit more for their follow-on rounds than they thought that needed. There are always twists and turns, even with the best of the companies. So that happened. Of course, we're largely immune, but not entirely. So we had a couple of cases where it was unclear that the traction was there. We had exits in both of those cases, and there were good outcomes for the founders and us. And then we have one instance of shared with 406 where we're doing a bridge financing, because it's exactly that case that Payal outlined, which is it is our mutual expectation that this company is going to be multi-billion dollars. And in fact, the company did this interesting analysis, if you want to really get your VCs intrigued, where they looked at their peers from the prior generation that they're disrupting and said, what was their trajectory, both performance and fundraising? And to Payal's point, I really want to double click on it. Some of the best companies have moments of flatness and then sharp curves. So, and we saw it with every one of their competitors from a prior generation, which is really fascinating, both in terms of its characteristic and typical for that market, but also it's not a straight line to success. And for every successful founder, there might be one in a million that goes J curve straight up. Most of them have all sorts of weird shaped curves that Payal's 2-year-old would draw until they get to that hockey stick. George, did we answer your question?
Yeah, absolutely. I really appreciate it. Just continuing to keep the ball rolling. I'd like to note that we're going to open it up for Q&A. So if you have any questions, feel free to do that. We'll probably reserve around 15-20 minutes at the end for that. So there's also the online chat if you want to put any questions there. Love to tackle those. Moving on to the last part. I mean, we were just talking about some maybe bringing a little bit of hope, right, to the bridge and to the down rounds, right, and keeping the hope train going. One of the things that investors love to think about is wins in the portfolio, right? But I think that sometimes people may be unprepared for when they have a win in the portfolio. What does that mean? How do you manage that, right? And so I'd love to get your all of your impressions on that. How does a firm manage distribution to LPs? What does that mean? Right, you hear that at kind of a general level, but logistically, what does that actually mean?
Do you have a particular person you're guiding? Go ahead, Payal.
Yeah,
Well, I was going to ask Ari. Ari, have you any angel wins to talk about? Or are we too early in the angel portfolio construction?
The syndicate has. I have not yet.
Okay. And how did the syndicate? Is there any point of view on from the syndicate distributing, and then we can give the institutional?
Yeah.
Yeah, I mean, I think it's a lot simpler at the angel level. I mean, we create an SPV for every investment, and the distributions all take place on the back end. So you as an angel investor don't have a lot of work to do managing that process. You just you foster the company as long as you can, and then you get a good email, and then you get a check in the mail. But yeah, I mean, I think it's the one thing I would say about angel investing is that the check in the mail that comes back is often a lot smaller than you think it was going to be at the beginning. The math is a little tough in the angel world, but that's also, I think, why that is such an important it's such an important layer of the ecosystem, because basically none of these companies that you're going to hear the good stories from Payal and Rudina, none of them would have started without that first influx of friends, family, and angel. So I think it takes a long time. Angel investing is really not about you're not doing it entirely for the returns. You're doing it for the experience. You're doing it for the ecosystem. And if you get the win, you get the win, and that's great.
And I think it can be a bit more complicated on the institutional side for a few reasons. Also, I think backing up, who are the investors, right? For funds like 406 and presumably Glasswing. For 406, where it's all institutional investors, so it's pension funds, endowments, and family offices, but to really high net worth family offices. And so to raise 300 million plus, it's not individuals, though we do have some. And so those folks have a very specific set of expectations around distributions and your decision making. So I think I'll give you one example that sort of answers the question really well, George. So we invested in a company called Iora Health, Boston-based primary care clinic. You guys know, Rashika is everywhere. Rashika Fernandopoulos, right? And my partner, Liam Donahue, who's one of the founders of the firm, was the first institutional capital into that company about 10 years ago. And what they do is sidestep. They've reinvented primary care. They take risk on primary care patients, and they introduce actually a multidisciplinary team type of primary care that actually improves outcomes and is much lower cost. And so they take Medicare risk and Medicare Advantage risk. And so about a year and a half ago, we sold the company to One Medical for about $2.1 billion. And that was an all stock deal. And so the LPs came to us and said, oh, okay, so you're going to get out of the One Medical stock, right? And we said, no, we actually believe in this long-term vision of combining Iora's primary care, which is full risk, and One Medical's subscription, consumer-oriented primary care, and being able to serve a patient from what they called like cradle to end of life. And so, no, we're going to hold the stock here, and we're going to ride out. So that was a moment in time where the LPs came to us and said, George, to your point, what are you doing about this when you'll have the opportunity to distribute? And then thankfully we did hold, because Amazon just acquired One Medical, right, for nearly $4 billion. And so at this point, there was another point from the LPs, because we're holding stock in the public markets, right? What are you going to do with that? Are you waiting for the transaction to close, or are you going to exit and or distribute? And so we've taken some specific moves on that. And so I think the one thing, when you have an all cash transaction, it's pretty easy. It's obvious. You got to distribute the cash. We all have, this is a bit too much detail, but you can recycle some of it, but you have to distribute it, right? When you have sort of public exits or public transactions, that's when it can get a little bit more complicated. And we as a firm do not distribute public stock holdings.
I think very similar thoughts in that when you have exits, it depends on how big are the exits and where you are in the cycle. I think in a cash transaction, this notion of recycling becomes very important. For those of you who are not familiar with that, just a little bit of level setting. What it means is, typically different funds have different structures, but the typical is that you can recycle up to 120% of the fund. What that means is, instead of returning cash to your investors, to your limited partners, you can take a certain percentage and redeploy it back in your companies. Why? It's a wonderful opportunity to get more capital to work than the size of the fund. Why do LPs care? Because you're not charging them a fee, that's fee free, and you're maximizing the opportunity for upside. So that's that. So typically, especially when you get your first, cash exits in, you start thinking about the recycling piece. And then very similar to 406, we have sophisticated, institutional LPs, pension funds, endowments, foundations, single family offices, etc. And some of those have different priorities. And some are particularly sensitive to holding public stock, which is what Payal was indicating, for regulatory reasons, all sorts of other reasons. Foundations and endowments are non-for-profit organizations. They have other sort of tax considerations. You have to be thoughtful so you're not triggering any issues for them. So it's funny. It's not as simple as hey, I made you money, here you go. It's a little bit more complicated. Is not simply if you're returning cash or stock, and we only return cash. If it's public stock, we transact on it, i.e. Liquidated and return stock, or return cash rather, but also how long you hold it. Did you miss the mark? I mean, you get into this territory of now timing public markets. Do you do it in a lump sum? Do you do it over a certain period? So there are a lot of considerations, but fundamentally the goal remains the same, which is maximize the return that you put in the hands of your LPs.
Mhm.
By the way,
And-
you also have, if I may add, you also have other considerations. For example, and I think Viola, I suspect this holds for you as well, but and for Artie as an angel, as first investors in this early stage startups, a lot of these investments qualify as small business stock, so they have different tax ramifications. So the timing when you exit them, at 5 years earlier or after, makes a difference as well to the ultimate return. I mean, 20+% of savings on tax is nothing to sneeze at in the millions. So it's more complex than one would think. I'll pause at that.
Yeah, and I think it's, look, above a certain fund size, we have great finance teams that are waking up every day and thinking through this. So that's just the reality. And George, there are a couple of questions in the chat here. I'll just follow up on one that Matthew said. The company I reference is IORA, IORA. And actually your question about guidepost, do you change investment based on whether it's going to has the potential to be an IPO or be a buyout or a strategic sale? I think that's a great question around portfolio construction and strategy. So, and that's part of the reason why we've kept our fund sizes at around 300 million, because the most common exit in enterprise is actually a sale to a strategic that's in the 500 million, actually really probably 350 million to $1 billion range. And so if that's the most common outcome, you want to build your strategy for that exit and for that outcome. We've had many exits over $1 billion or multi-billion dollars, but we don't need those to get the fund return. So to your point, our strategy doesn't change whether we think there's going to be a buyout or a strategic sale or an IPO. It's the same. We're investing 4 to 8 million initially in a company like IORA. We participated in every single future round. And so to Radina's earlier point, we have reserves for that. The initial investment's usually at least 2 to 4x reserved for follow-on. And you'll find at exit, and IORA is a good example, we were the largest institutional shareholder there. Many of our companies across the portfolio, we're the largest institutional shareholder at exit. And that allows you, when you sell a company for $500 million and you own close to, anywhere from around 15% to 20% of that company, that allows you to return a third or plus of the fund with each exit. And we have had many cases where we've returned nearly a full fund with an exit because of that strategy. So hopefully that answers your question.
And to build on that, because we didn't talk a lot when we talked about portfolio construction, we talked about it from an input perspective, but you also do your exit analysis on your portfolio. And as you get in the later life of the portfolio, what kind of deals am I going to do as my last 1, 2, 3, to come full circle to the initial question. You also look at who are my top performers. Make no mistake, ladies and gentlemen, it's a hits business. You have 1 or 2 that hit it out of the park, return the fund multiple fold. You have a middle pack that might be your 2 to 3x, 5x, that range returners, and then you have your underperformers. And you are constantly looking at your portfolio and saying, how are the pieces moving? That informs your outcome expectations. That informs where you're not just sort of holding reserves blindly for all of the companies as they evolve. Some need less cash, some don't need cash, but you want to put more in them. So it's an ongoing management. There is a question from Stephen Goodman about sort of the how do you avoid herd thank you for projecting it. How do you take exciting, innovative, high risks, and how do you avoid essentially herd mentality? So for us, effectively, we're market making. We're the first investor in. I shared 80% of the time, and that means that it could very well be that Artie and I go into the investment at the same time, or the friends and family round is bypassed, period. We often will leave room for angels and friends and family in our own rounds. But listen, this is where thesis and domain expertise becomes very, very important. We are in the business of backing founders who have execution abilities to transform the future or to disrupt the space. If you said to me, Rudina, go invest in a life science company, I can't spell it I wouldn't even know where to start. So knowing where your strengths and your domain expertise is, and not simply relying on that, but evolving with that. That's why we talked about the thesis approach. That's why I said thesis and themes are living things. So you need to go in a particular company fully grounded in knowing what the market dynamics are, in knowing what the founders can do, sort of gauging their abilities, and due diligence in the tech. The rest becomes execution risk, and execution risk is what we specialize in doing. Fundamentally, we're in the business of de-risking these companies in spaces that we know and we can add value for.
So we do have a couple questions on this side. I know from my own edifice. So there was a lot of conversations around how there's multiple new funds been popping up over the past few years, but each of those newer funds have been created with very specific mandates or as extensions of existing companies or associations, and so they kind of exist for the benefit of that company or association. So as you think about this kind of ecosystem, and the fact that the Fed just raised rates by another 0.75 percentage point, you have this balancing act where there's a need for smarter money, and valuations are starting to come down from startup side. So they're not coming down as fast as maybe some investors would like, but they are starting to come down. So do you think that the agnostic VC firm or angel group out there is really becoming the resource of last resort as it relates to a founder pursuing a fundraising round?
Interesting question. Thank you for that. There's a lot in there. I'll just start with a couple thoughts. I'm sure they can give others the time to have much better answers. So in healthcare, we have seen in the last 24 to 36 months, a lot of healthcare specific funds being raised. And I think this was a bit of your point there. They are funds being raised specifically to invest in what we do, healthcare tech and tech services, and so on and so forth. So what that has resulted in is, to your point, even as rates are increasing, and Rudina alluded to this earlier, there's still a lot of capital available for companies for initial rounds of financing and follow-on financings. And so that hasn't, because it's always supply demand, right, back to our economics, you're not seeing valuations compress as much as you would, at least in healthcare, because of the availability of capital. For founders, I think you generally, what we see at the Series A stage is, and we just beat out, we'll see this routinely, we just beat out at the Series A stage one of your bi-coastal branded generalist funds that everybody knows for us, because they were like, we know how hard it is to build this company, and we want someone at this stage who can help us get from here to there. We'll go take that firm's money for the next round of financing. And so founders are getting smarter about that, and starting to select the more specialized funds. You're always going to have founders that are going to pick your Andreessen, Sequoias, General Catalyst, et cetera, of the world. And but that is the type of founder that we generally don't back, and we're okay with that.
So from my point of view, I encourage you to think of it as different products. Just like you have different software products, you have different products in the market. You have the big generalist funds where you have 1, 2, 3 partners that specialize in a particular area, and then you have entire firms that have what is commonly known as focus strategies, which is exactly what you were alluding to. I assure you there is room for both. my inclination, if I put I've been in venture now for 18 years, we've seen this cycle, and you've seen this cycle even with when we saw Tiger and Cotu and all the big hedge funds, they're a whole different set of products. Here's a term sheet at a crazy valuation. You're on your own. Here's your 100 million, move on. So it depends in part on what the founders are looking for. But also, in my view, earlier stage, you need a lot more support. Later stage is a lot more about scaling. So in that regard, domain expertise and VCs that truly get both the ins and outs of early stage and particularly of the space you are in are much more valuable than a generalist fund. A generalist fund comes with a brand name. Oftentimes, that's sort of today's generalist funds didn't all start as generalist funds. They just got bigger and bigger over time. So some of it is an artifact of time and market dynamics. And hence top brand names that have been around for 20, 30 years open doors. Make no mistake about that. But it is not uncommon for founders to complain that, yes, it opens doors, but they're not getting the attention. They're a drop in the bucket, as opposed to, the help that they get early on. So I hope a smart founder finds a way to combine the two. And I'll leave it at that.
Yeah. And I think to piggyback on that, and it scales with the size of the company and the size of the investment. I think at the very earliest stage, there's almost no such thing as a true generalist, someone who's just getting into companies for the sake of it. Even an angel group, like for example, the one that I'm a part of, the syndicate at large is, technically agnostic, but every person within the group has a set of domain expertise, and every deal that's brought to the group is led by somebody who has deep expertise in that individual area. And I think to some degree, the same pattern exists even in the large agnostic institutional levels. The firm overall may, invest in everything across the board, but then you open the hood at some place like 406, you might say, okay, cybersecurity, healthcare, and software are very different maybe, but each one of the partners and each one of those verticalized investment teams has this incredibly deep and somewhat narrow set of expertise. That actually, are there any more questions in the chat? Because I have one for Pyle. There isn't one.
There is one about non-dilutive capital in the
Okay.
seed and early stage. I think we see it in healthcare. We see it around sort of SBIR grants or other NIH-oriented grants or research, and I think that's great at the really, really early stage, also to help you advance milestones. When I think all things and all capital are fine, so long as you haven't set up or done anything to queer a cap table or make the economics hard to achieve for your venture capitalist to come in and lead the next round. So no issues with that. In some ways, they can help you really get to the set of milestones to be able to raise the next round of financing.
And then I think VCs take very different points of view on debt.
Yeah.
We like you to have the lines. We don't like you to use the lines.
Especially in this market.
So let's see. Is anyone else in the room here have any questions for the panel? Great. George, do you have anything else for the panel right now?
For Ari, did you say you had a question?
I just had one for you. I can ask it offline.
Okay, great.
I mean, if we have time, I think it might be interesting. Yeah. So I mean, my question is, and this is taking privilege of the position, but I'm really curious as to the and I wrote this down about 20 minutes ago.
Oh my gosh,
when you guys moved to the full consensus model to get your investments past board, I'm really curious as to what those conversations are like when something comes to the team that is, deeply, to somebody's point recently about domain expertise, that is deeply in the weeds of cybersecurity. How does Liam participate in that conversation.
Maria tells him to take a hike. No, I'm kidding.
No, you'd be very impressed with Liam's questions on chaos search, Radina. But no, look, it's a great question. And I think this is where, having been a partnership together, I mean, Maria, Liam, Graham, and Greg have been together 15 years. I've been there almost 8 years as part of the partnership now, right? Having that fluency with each other and that respect, I'm not going to ask you some question about the deep technical or cyber AI. So I'm going to defer to Graham or Greg on those specifics. But what I do feel comfortable about asking, where there's a lot of respect, is just a general, market dynamic or a pipeline or a go-to-market. I mean, those things are sort of fundamental and supersede a segment, right? And that's actually where we found the wisdom was when Maria, having been a 25-year sales executive prior to being a venture capitalist, asked us about a healthcare sales motion and pipeline. Even though it's different, there's usually wisdom in that question, right? And she's understands that there's nuance. And so I think it's that which we realized was actually, it's more about the respective expertise that we each bring. I come from a very strong technology background, Maria sales, Liam has been on healthcare, but understands markets deeply. So like we each bring something to the table that then gets us to the right answer. And I think the key of it is, to your point, it's not going to work necessarily for a partnership that's been around or together for a couple of years.
But it's more important in a partnership that's been together for a shorter amount of time.
Yeah.
So Artie, just for some level setting, I don't know if this is common knowledge, but unless the firm gets to be gigantic 50 partners where unanimous decisions are just, it's practically impossible. And then they divide in smaller investment committees, blah, 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 for these generalist funds. Most VCs have unanimous decision making. I.e. at Glasswing, unless all the partners vote yes, we don't make the investment. Rudina can love it morning, day, and night, and it really doesn't matter that I'm the founder and managing partner. Not only that, but honestly, even the non-partners, the principals and the senior associates, have a lot of say. There is a deal that this was right before COVID, so it was summer 2019 that we wanted to do. And it was our principal who felt incredibly strongly that we shouldn't, because he at the time had domain expertise. We did not do it. And I think that's healthy. I share that because it's healthy both in terms of you need to empower people, and you bring the smartest of the smartest together, title be damned. This is where, diversity of thought and different points of view matter. And secondly, I think unanimous decisions are something that most LPs expect. Mm-hmm. So the wisdom on the capital provider side, capital to us as funds, they have come to that same view over the decades of investing in our asset class, and therefore it's an expectation. So we can get into the nitty-gritty of which partner brings what, but but it's a skill, buying, getting everybody and building consensus. Mm-hmm. And it doesn't all happen at the investment committee meeting. It happens in one-on-ones, it happens in follow-on discussions, and when you have healthy constructive dynamics, a lot of the questions get asked up front, you address them, there's follow-up, and at least at a minimum, what the risks are, and them clear as day. Even if you aren't in love with a deal, what you are doing, as opposed to sort of, I love the founders, I love the space, I know this is a big market, let me go do it. No.
All right, amazing. I wanted to give a really great thank you to our panelists. We got some Boston-based legends here, so just wanted to give them a round of applause for waking up so early in the morning to go out and do this panel and having the mental acuity this early in the morning to be able to give out. We have
young kids, George. We've been up for some time.
Fair enough. I'm not there yet, but we'll
see. And I know. Go ahead, Radina.
No, I was going to say, and thank you to Startup Boston for creating this whole exciting week. I think as our ecosystem continues to vitalize and revitalize, I think you're playing an incredible role, and it's an honor to be part of this ecosystem and part of this week.
Yeah, I echo that. And I did input my contact info in one of the questions, but feel free to reach out. And thank you, George, for the moderation and to Startup Boston.
All right. Thank you, everyone.
Bye-bye.
Thanks, everybody.
Thank you, guys.